Welcome to Blue Dirt, the podcast that digs deep into the foundation of commercial real estate investing. Unlike most real estate shows that focus on deal making and market trends, Blue Dirt gets into the nuts and bolts of what truly builds long-term value, the building itself. We break down how to spot deferred maintenance before it costs you, why a solid preventative maintenance program is a game changer, and how triple net leases can maximize your investment returns. We'll also explore the importance of strong landlord-tenant relationships and how they drive stability and growth in your portfolio. Whether you're a seasoned investor or just getting started, Blue Dirt gives you the practical knowledge to make smarter, more profitable decisions in commercial real estate. It's time to get your hands dirty and build value from the ground up. Let's dig in. Welcome to Blue Dirt, where even idiots can make a killing in commercial real estate. Today's episode, well, I'm Michael Carro. This is
Don Redhead.
And we are going to talk about a case study of a recent property we purchased. But I'm going to start off with the questions that we plan to answer today. The first is, why do we like this property? How did we find it? How did we analyze it to determine whether or not we thought it was a good idea to close on it? How we financed it, and whether or not we think this is a good long-term or short-term hold. And then ultimately, if we do buy it, what do we plan to do from a renovation standpoint and a budget standpoint? So, Don, anything to add?
Yeah, no, all that sounds perfect.
Great. Well, let's dive in. So this is let's give you the background on the property. It's a retail center in Pensacola. It's just over 18,000 square feet. It's a 4-tenant building that had 2 tenants in place that were month-to-month leases. The leases themselves were gross leases, and we can explain the difference between gross, triple net, full service, and they were significantly below market. Now, Don, how did we find this property?
I came across it on, I think it was Crexy, just one of our softwares or websites that we use to find commercial real estate. It's a great platform. And it just jumped out. It kind of fits our model. Usually properties that are in a bit of distress, delayed maintenance, good price per square foot. And I can't remember if you were working with somebody who was looking for space, and I thought that this may help, and send it over to you. And from there, just kind of follow the natural bouncing ball process that we have.
That's exactly right. So Don, this was on the open market. It had just come on the market maybe, a week prior?
Yeah, it was very, very recent. It was very new.
And I will tell you, we don't typically jump on stuff right away. On very rare occasion, something's fast and we move on it. But it's not uncommon that we'll find properties that have been on the market for years. And I've got some great examples that, as you listen to other podcasts, we'll go through a lot of our assets and we'll explain each one because they're all so unique. But again, this one's retail. What jumped out, as Don mentioned, was the price per square foot was great. We love problem children. This was a problem child in the sense that once we get into the renovation budget, you'll understand. We tend to buy a lot of properties where the current ownership may not have they don't have the cash flow in the property to keep reinvesting and upgrading. So eventually the property degrades over time and then loses a lot of its luster and value. And quite honestly, that's what we like. We do not have a short-term view on most properties. We approach them with the understanding that, and I'll tell you a little bit about the model that I have. Is I have a 3-year model in that by the end of the 3rd year, my goal is that each property pays distributions. A lot of folks in residential investing, they talk about how the properties are going up in value, and that's great. And then they'll realize their gain when they sell. I don't want that. I mean, of course I want that, but I want to see value while we own the property, not just when we sell it. And so I expect each asset we buy to pay distributions every year. Now, whether it's annual, monthly, quarterly, I don't really care how they're paid. But if the property can't pay me while we own it, I'm not buying it. So on very rare occasions, we'll do a flip, but that's not typically our model. We are a long-term hold. And so when Donnie sent this to me, and by the way, why don't you talk about how quickly we react on things?
I think that's one of the benefits, the fact that we're in this space every day, it allows us to really analyze things pretty quickly. The fact that we work with other buyers. I mean, you're obviously day to day sell dirt, represent tenants when they're finding locations. So we're always looking. So really the big differentiator there is when you look at 1,000 different, deals a month, whether for tenants, for ourselves, for whatever, we're just working in the space. A lot of times you can see that and just identify it's a great deal pretty quickly, right? Or at least it's something that deserves additional attention. You can say yes, no, or no, 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 yes. Okay, let's jump into this a little bit more and at least peel back some of the layers of the onion to see how bad really the space is. So this one, maybe 2 days, maybe. I mean, between going there, showing
and you brought something up. So I was working with somebody that needed a space, and this particular 18,000 square foot center had about 8,000 square foot of availability. I was looking for somebody that could use this space. I immediately called that person. They had interest. I sent them over a contract. You have got to be fast. When you make a decision, move at the speed of light, because if it's a great deal, other people are going to be looking at it as well. And so now at this blink in time, I didn't know anybody else was looking at it. So I sent it over to the client. He said, "Oh yeah, send me over something." But he was very lackadaisical, and he didn't sign the agreement. When I say the agreement, I sent him over a purchase agreement, did not sign it. And so I said, "Screw it. We'll get it under contract. If one of my clients ever wants it, they can have the contract. I don't really care. But you have nothing until you lock up that property. Until it's under contract, you've got nothing." And so,
that's where it seems like, so at least I hear a lot more than I realized, was everybody wants to analyze the property. They want to go in and they want to start
analyze.
Yeah, they just want to keep analyzing, and you really don't have anything, right? You don't know if you even have a real contract.
To be specific, they want to analyze before they're under contract.
Correct.
So you have to overanalyze once you get it under contract. But the key is until you get it under contract, you have
you don't have anything.
That's what you're referring to.
Correct. That's exactly right. I want to say they all, but that is definitely a very more common issue than I realized that. And I think it's just the psychology of it, where they want to come in, they want to, well, how does the AC look? How is this? How is that? And they want to analyze everything. But until you have a deal, until you have it papered, you really shouldn't be moving forward with anything.
Right. So in this case, we lobbed it. I think the asking price was 1.1 million. We lobbed in an offer. And by the way, that was a fair price as is, but you never want to offer full price. Even if you are willing to pay full price, the reason is there has to be a struggle during the negotiation. Just has to be. Otherwise, the other side feels like they could have got more. And if you don't offer enough and they accept it really quick, then you feel like you went in too high. So we put it in an offer at $900,000. The brokers were from outside the area, called them up, great guys. And they had mentioned, "Oh, we're not really considering this offer. We have 2 other offers, and one of them is full price." Well, I immediately crunched the numbers at a higher price and went in above ask. And I went in $20,000 above ask. We ended up getting under contract.
Mm-hmm.
So this is where, so now that we control the property, now we can go through the steps of complete analysis. And so this is where Don then goes in and looks at the physical. So we're going to talk about the physical asset, which is what Don handles, and the financial asset, not the asset, but the financial analysis, which is what I take care of. So why don't you talk about the physical asset, what you found, what you discovered, and then how you went through the budget of what was needed?
Yeah, so that's a really good point, because what we do is work, I will say, in tandem, right? So Michael starts running, kind of reviewing leases, looking at the market, working on financing. a lot of these kind of behind the scenes things. And what I'm looking at is the physical asset in terms of, say we buy this, what do we need to make it whole? Right. Because even though we love problem children, we don't want to keep them as a problem. We want to turn them around into something that is actually relatively easy for us to manage. I don't want to spend a bunch of my time being there all the time with bad maintenance issues. So what we do is a little different than what you're going to see most individuals or most companies, where they bring in the classic inspector where they review everything and don't really assign any value to the repairs. And that's where we get the respective trades in there that really understand the roof. They really understand the plumbing. They really understand the mechanical. They really understand the structural. So all of the big ticket items,
MEPR, mechanical, electrical, plumbing, roof. And then you can add structure on certain buildings.
And this one needed it, right?
Yeah.
Because when you get there, you can really tell, and depending on
it's only a single story building. However, there is visible cracks in the block construction that needed some attention, and then there was certainly water intrusion, which we need to take care of. So
that if you really look at it and kind of listen to the building, it's going to tell you the story. It's going to tell you that there's issues going on here. Don't just glaze over really what you're seeing there and just attribute it to maybe delayed wear and tear. It's going to speak to you and say, hey, there's probably a moisture issue here. And that's what us being in Florida, we deal with the vast majority of the time. So get the mechanical out there. Hey, here's what you have. Age of units, size of units. Are we properly sized for what we have going on? So we really dive into there because we know that a lot of times people put, Band-Aids on things, and we know at the end of the day, who's going to be paying these costs when it's all said and done is going to be us. Right?
And by the way, when you plan on doing a long-term hold, Band-Aids won't serve your needs. Go ahead and bite the bullet and do things right the first time, because what that's going to lead to is more tenant satisfaction. And the greater the tenant satisfaction, the longer the term that they're going to be there. If you can really take care of your tenants, because it's a partnership, landlords and tenants are partners. If you think you're a landlord and you have control of your tenants, you're wrong. They are your family, and you should treat them as such. I see so many contentious landlord-tenant relationships when they don't need to be contentious. Now, if one of you, landlord or tenant, are not performing according to the terms of your lease, that's a different story. And most of the time it is a tenant situation. But I've seen a lot of landlords who are way too intrusive on their tenants. Go ahead.
Yeah, and of course, as we go down the road with more and more of these episodes, it really is, because our examples with those, we can really help blossom that relationship. And ultimately, since we have more property, they maybe outgrow a space, we can put them into another and mitigate our vacancies, throughout kind of the longevity of our relationship with these guys. So, but getting back into, prices back from mechanical, saying, hey, this unit is undersized. This one needs repair. Here's $3,000 that it's going to need.
Well, let's be more specific. So one thing we want to accomplish on this podcast are actual. We're not going to be theoretical. I mean, we'll talk theory when it needs to be, but in this specific case, we got the property under contract for $1,120,000. Don reviewed the expenses and came up with a total of $247,000 in deferred maintenance that we needed to invest. And with those, how did you divide out the 250?
So 250, essentially 26,000 in mechanical.
Okay.
Really between a couple different units there of the vacant units. We had roughly 31,000 in electrical. One of the existing tenants needed some new lighting done, and that was part of the lease negotiation, but we factored that in.
Right.
The other part was roofing. So we had $113,000 for roofing, which is obviously the big one.
Right.
Flat.
Always
roof,
is typically the biggest.
Square foot.
Yep.
Right? Yep. And surprisingly, it was actually in pretty good condition. And a lot of times what we look at is topography, on the roofs to make sure they're draining properly. Structural, fortunately, was wasn't as bad as we originally thought, but still 18,000 and masonry work that need to be done. Painting, we had around 15,000 for the budget. Door upgrades around 6. The parking lot was in that good shape that we like, that it just needs a seal and stripe, doesn't need the big, going over and milling it up. So we're about 8,000 there. For a few extra things, cleaning up, demo, soft wash, et cetera, we're around 19,000. And then we just, of course you want to have a little extra there, around 10,000 for miscellaneous. So that's ultimately how we arrive there. But the real key indicator there is really engage the people who know what they're doing. Engage, your electrician that you want to use, and have them look at it, because they're going to know those details.
So the point is what Don does is he has the actual tradespeople that they're going to inspect, but anything that they find wrong, should we close on the property, they're also going to be the ones to go back and fix them. That's the key. So that's what he ultimately does, is we have the tradespeople actually go in and do the inspections, and then come back, provide the quotes so we can do the analysis before we purchase. But then once we purchase, I'm saying the day we close, we order everything. Now we start from the outside in. There's no reason to fix the inside if you've got a leaking roof or if you have issues on the outside. So we have to create a sealed envelope. Roof and structure has to be tight and right. Then we can go inside and make those improvements. So that's essentially the part one of Don's portion of the due diligence. And then I take those numbers. So we got $1,120,000 purchase price. We've got $250,000 in renovation costs. So what we don't do, what a lot of people do, especially if you haven't been around enough, is if you're buying a property for $1 million, you go to your bank and say, hey, listen, I'm buying this property for $1 million, and how much will you lend me on it? And it's usually a loan to value. They might say 80% loan to value, meaning you have to put 20% down as a deposit, and then they will finance 80%. And it's, of course, versus appraised value and all these other things. So in investment properties, it's typically a little bit more than that. If you're the owner occupier, 80% is probably a good rule of thumb. But if you're an investor, a lot of times it's less than that. They're only going to give you 75 or 70% of the loan. Because as an investor, we're higher risk. And so we put more money down. Doesn't mean we're going to have to pay higher interest rates. But then when you get your loan for that $1 million or $800,000, you put $200,000 down. Well, then guess what? Then you have to put the additional $250,000 in renovation budget. So you were out of pocket $450,000. We don't do that. When we go to the bank, we're asking, hey, we've got it under contract for $1,120,000. We need an additional $250,000 for renovation. So now we have $1,370,000 that we need. Then we'll get the loan to value based on the $1,370,000. And let's just, using the 20% as an example again. Well, now we need roughly $275,000 in cash versus 400 and whatever I said before in cash. So you should be wrap that renovation budget into the cost of the loan. And so that really helps them to give you all the money you need, and ultimately you get out of pocket for less money. So I'm going to walk you through some details. The asking price was $1,000,001, which was $60.90 a square foot. The cap rate that they were advertising was horrible, but and so cap rate investors would not look at this and buy it. You have to look way beyond what it is. The cap rate was 4.02%. And so really cap rate was not a factor for us because this was a problem child that we needed to improve. We actually offered $1,120,000. We actually got a $10,000 credit before closing, so we ended up paying $1,110,000. That's $61.45 a square foot. So we paid about $1.55 more than our closest competitor. So that $1.55 got us the deal that we wanted. And so we had a 45-day due diligence. So that's when you look at terms, price is part of the package, but we were able to move quicker. So typically on a commercial real estate deal, 60 to 90 days is what you need for due diligence and another 30 days to close. Well, we had our ducks lined up in advance. We had our lendings lined up. And let me talk about lending for a second. Most people that I deal with are thinking that, oh, I've got my banker. He's great. She's great. No problem. And I encourage everybody to reach out to 10 lenders. Every time I do a deal, I reach out to 10 lenders. And I'm going to tell you why. Lenders have a portfolio of different product classes, different types of products that today, if you're going to buy a restaurant property, they might have so many restaurants in their portfolio that it doesn't matter who you are. They can't, based on their ratios, they can't take on another restaurant investment. So your banker may be in that situation and they can't even give you a loan, even if they want to. So you need to find those that have availability within their portfolio for that product class. So I'll tell you how it typically goes for me. I send an email out to 10 lenders. I get 6 super fast no's. And I got to tell you, I love and appreciate a fast no. They don't offend me. I appreciate it. Boom, done. I usually get 2 offers from lenders that are basically a no because their terms are so horrible. But that's okay. At least they're my backups. And then I usually will get 2 deals from banks that just make a lot of sense. I mean, I can get this deal done. And so it doesn't really matter that the interest rates a couple of years ago, I had one loan that was 8%. But for the property that I was buying and the price and everything, it still made sense. Now, some of the properties that I might have bought 5 years ago, maybe they wouldn't make sense at 8%, right? And so, but at the time, they might have made sense at 4.5%. So you have to look at the totality of the deal. Don't worry about the interest rate. If the interest rate works for the deal that you're getting, then so be it. And by the way, I typically pay extra for a 10-year term. Now, I'm not going to pay extra for a 10-year term with an 8% loan, but we're locked in on a lot of our deals between 4 and 5%, where we paid extra. When I say paid extra, I mean, let's say we could get a loan with a 5-year term at 4.25. Well, I might pay, for a 10-year term, I might let them increase my interest rate to 4.4%. So maybe 15 basis point increase. I'm okay with that. As a long-term investor, I care about stability in my loan and not going back every 5 years, hat in hand, saying, please, lender, please, please, please renew my loan. Well, if I did all my 5-year terms, I would have a whole bunch of loans coming up that were maybe in the 4 to 5% range that are going to get renewed between 7 and 8. So,
yeah. And one of the biggest things that I've at least heard other people in a very discouraged way is they come out and they'll go to their banker and get the no and just think that they can't buy real estate. And they just go on their merry way thinking psychologically that, all banks are going to say no because one said no. And like you said, even for individuals that buy a lot of real estate, they're going to get 6 of the 10 are going to be no's. So don't just because you're getting the one no, you got to keep going. You got to keep, being more persistent.
And those clients that work with me, I really help them understand that, because I'm going to tell you, it's easy to get discouraged because you think it's you. And by the way, it may be you, but it could certainly. And by the way, a good no from a bank, the question is why are they saying no? Are they saying no because their portfolio is full? Are they saying no because you didn't get them all of the information that they needed to be able to underwrite you for the loan? Are they saying no because the financials on the property are so horrific that they can't justify it? I mean, so it's good to understand the no, but I'm so used to no, it doesn't bother me, and I'm unaffected. But I also know that I'm analyzing my properties in a way that makes sense for me. And so once I understand the financial part of it, and so this particular property, so we had, let's see, the loan. So we had a budget of $250,000 for renovation. Where is my loan information on this? Oh, here it is. Okay. So we went with a local bank. We had a 65% loan to value. That means we had to put down 35%. So our down payment was $475,000. So So that's what we put down. But let me run the model for you. When we ran the model, I use a CCIM model. So I plan on buying day one and selling at the end of 5 years. So you have to predict this model. And so the 2 leases that were in place, 2 of the 4 spaces were leased. The 2 leases that were in place, I'm going to tell you, the lease number 1 was over 7,500 square feet. They were paying an all-in rate of $6.87 a square foot. That, if you assume that the triple net is roughly $3 a square foot, that means they're paying $3.87 a square foot when the market is about $15 a square foot in this particular area. So far, and they're on a month-to-month lease. This tenant is a phenomenal tenant. They've been in place over 40 years. They are national in scope, fantastic. They knew they were getting a phenomenal deal. Why would they fight it? They're great people. The other tenant, it was over 2,800 square feet. They were paying $8.80 gross, which means they were paying under $6 a square foot if you include the triple net. Again, month-to-month lease. So as soon as we get under contract, I'm having conversations. They both recognize that they were under market. And what we were able to do was work out a good, healthy relationship that still had them below market, but in a range that made sense for them, but then of course made sense for us. And so I don't mind. My goal is to always keep our tenants in place, and we will work with them, but we can't lose money like the previous owner was losing. He was losing his butt on this amazing property. Now, when I say amazing, it's ugly, and Don and I are making it beautiful, but it's still an ugly property that we're going to, and we will get into the point where we show you before and after pictures. This one it hasn't even been painted yet. We just closed on this less than 3 months ago. The roof has been, well, why don't you talk about what's been completed so far?
Yeah, roof completed last week. So that was great. Got that phase done. A lot of electrical work has been completed that we wanted to add additional exterior lighting, make it more secure, safer feeling for the tenants. HVAC, we haven't had to do much for because really our budget allocation was for the vacant units. So once those get leased up, we'll be able to release those funds and get that in working order.
Well, hold on.
Painting.
We don't like to put air conditioning on units until we have a tenant in place. There's always a threat of vandalism, or sometimes idiots will get out there and strip out the copper of places. Copper prices right now are on the rise. So unfortunately, when that happens, you get morons out there who will go out and strip out a $10,000 unit for $100 worth of copper. And it's really, so we're going to be patient and wait. Once we get a tenant signed up, boom, we'll put the new unit on the building.
And you don't know what kind of tenant's going in there, right? If it's a restaurant, they may need a different one, and you may just assign, hey, I planned on putting $10,000 into new HVAC. Here's $10,000 because you're going to need that towards a more complex unit. Maybe it's a nail salon, right? So there's a little part of you that you don't want to spend too much money because they may need to rip it out and redo it anyways, right? The masonry work we had, that has been all cleaned up, and they've started on the exterior painting now. So that was good. That was one of the delays that we ran into, just getting the mason on the books.
I was out there yesterday. I saw that the sidewalls looked like they were painting, and the painters were out there rolling. So
yeah, I'm excited. So it's moving right along. I'm excited. Probably another week or so really take shape with the new paints.
So we mentioned we paid $61.45 a square foot. The renovation budget on a price per square foot basis is $13.72, bringing our total, once we were all completed, we're going to be into this building for $75.17 a square foot. Of course, it's all plus or minus. Don's getting some better deals on some of those items, and we'll ultimately have to pay probably more on some. So it all balances out. So we're going to be into this asset for about $75 a square foot. The key is you can't build these types of buildings for under 200. So when we look at them that way, now it's not in the greatest area. So, but when you look at the long-term hold, you got a great asset. We're investing the money up front. The tenants are going to be very pleased with us. And then our goal is to then backfill it. So let me tell you how we modeled this out. So we modeled it out averaging $10 to $12 a square foot, because at $10 to $12 a square foot, we can still be under the market and still offer a great product and make a great return. So using that methodology, we're over 50% full today. So the first year, the way we modeled this is I modeled it at a 25% vacancy. And then years 2 through 5, I modeled it at a 10% vacancy. So that's assuming that last 2,000 square foot unit doesn't get leased, even though I think it will. So now we have a 10% vacancy. Here's where the magic happens with internal rate of return. So the internal rate of return, and the internal rate of return is a cap rate is a measurement for a blink in time, a 1-year measurement, which is net operating income divided by the sales price equals your cap rate. Okay. And we mentioned that the cap rate that we bought it at was 4.02%. Why was that? Because the rents were super low and the vacancy was high. You wouldn't buy a fully leased center like this for 4% cap rate. It's just too ugly. You wouldn't do the deal. But when I modeled this, I modeled it at a 9% cap rate, meaning that the buyer gets a higher return on investment. And this is more likely to trade in the 9% cap rate if we were able to get this thing filled up. But here's where it happens. So we have if we use a projected NOI of $200,982, if we use a cap rate of 8.5%, that is a sell price of $364,494, assuming closing costs of roughly 5%, gives us $888,000 cash on cash return, which is pretty significant. Now, if we hold it for 5 years using the vacancy methodology and at the price of $10 to $12 a square foot, we are still going to yield a 27.83% internal rate of return before tax. So each one of us are in a different tax bracket. So then you add your tax situation, and that'll reduce your internal rate of return down after tax. So this CCIM model is what I run on every property we purchase. And I'm always going to target higher than a 20% internal rate of return. Why am I going to do that? We take on higher risk properties. So if I miss, I'm still probably going to get in the double digits. Okay. But knock on wood, we have not missed yet on one of our assets. And when we have purchased over 40 properties using this methodology in-house. And so we've been very, very blessed on how the model has worked for us.
Yeah, there's a lot to unpack as far as I think there's definitely a lot of material to go into understanding the gross lease conversion, right? To triple net, the analyzing. I mean, there's a lot of, I think, really good questions that can be asked about just this one deal in general. So I think that's going to be a lot of good material for other ones.
Yeah. Well, let's wrap this up with the last question that I did not answer is long-term hold versus short-term hold. So I go in with the mindset of wanting to hold my real estate for retirement, long-term hold, pass it down to the kids. I don't really care, but I don't flip properties. On a rare occasion, and it's only been a couple times, have I gone in to a purchase with a short-term mindset as part of the plan. This property happens to be one that I do want to analyze at the end of the first year and see if we want to sell it. I think that if we can get the 6,000 square foot space leased up to a good tenant, if we can get the other one leased up as well, that would be great. But I think, and you have to look at how much you're going to make on an annualized basis. But this, I believe, has the potential to make $1 million in 1 year. And the reason why we want to hold it a year is to go from ordinary income tax to a capital gains tax. And so I think a year and 1 day, you get into the capital gains tax, and it really reduces, maybe 10 to 15%, depending on your tax bracket, in capital gains. So So we're, depending on how it goes this year with the lease up, there is a chance that we would say, you know what, let's go ahead and take the win. Take that $1 million gain. Maybe it's not a full million, but maybe it's 800,000. So my guess is 800 to $1 million. And so if you think about it, we invested 475,000 with our lender. If we sold it, we get the 475,000 back plus another 800. That's a heck of a return. That's almost 200% within a 1 year period. Now, if we don't sell it, it doesn't matter. This one is a win-win either way because the cash flow on an annualized basis, if we hit all these metrics, it's going to be fantastic anyways. So this is one of those that on the rare occasion, we are going in with maybe a short-term mindset, but we may own this for the next 30 years and we don't care. It's a great asset.
Yeah, we'll see. Maybe we'll have an update when that happens.
Yeah, give us a year. We'll talk about it.
Yeah,
and we have got a lot of other properties to discuss. But we want to thank you for joining us today for this version of Blue Dirt, where even idiots can make a killing in commercial real estate. That's a wrap for this episode of Blue Dirt. We're here to help you build smarter, invest wiser, and create long-term value in commercial real estate, one solid foundation at a time. If you found today's insights useful, be sure to subscribe so you never miss an episode. And if you know somebody who could benefit from these discussions, share Blue Dirt with them. Got questions or topics you'd like us to cover? Reach out. We'd love to hear from you. Until next time, keep digging deep, stay sharp, and remember, real value is built from the ground up. See you on the next episode.